Hello everyone, welcome back to Ananta Wealth Management. Today we will be discussing about buy-sell agreements, a simple plan that helps a business keep running smoothly when an owner expires or becomes unable to work or even retires. So, why is this plan so important? When there is no plan for what happens to an owner's share, a lot of stress can fall upon the business, upon the remaining owners, and even upon the family of the owner who left. This can cause big problems. A buy sell agreement helps resolve this problem. When the plan is funded with life insurance or disability insurance, it makes sure there is a buyer for an owner's share at a fair price. So, how does a buy sell agreement helps? The main benefits are it makes the change of ownership smooth and clear. It also keeps the business in the hands of the right people, not strangers who may not fit well with the team. It also provides cash quickly to pay for the owner's share when needed. In simple words, a buy sell agreement is a legal promise that when a certain event happens, like death, disability, or even retirement, that owner's share must be sold to another owner or to the company, right? This is very useful for businesses that are not on the stock market because it makes it easy to sell shares and avoid arguments when times get tough. Many buy sell agreements uses life insurance to pay for the owner's share. This means that if an owner dies, the life insurance money is used to buy that owner's share at a fair price. To sum up, a buy sell agreement protects the business and the owners. It makes sure that the change in ownership happens smoothly, keeping the business with the right people and gives cash when it is needed most. There are different types of buy sell agreements. Among them, three common types of buy sell agreements will be discussed now. Among those three are cross purchase agreements, entity purchase agreements, and wait and see agreements. In a cross purchase agreement, each owner purchases a life insurance policy on the other owners. When an owner passes away, the surviving owners receive the death benefit from the policy. The funds are then used to buy the deceased owner's share. This arrangement keeps the business within the original group of owners and ensures that the transition happens smoothly. With an entity purchase agreement, the business itself buys a life insurance policy on each owner. In the event of a triggering occurrence, such as death or disability, the business collects the death benefit from the policy. The company then uses these funds to purchase the departing owner's share. This method centralizes the process and helps maintaining um, stability within the business. A wait and see agreement offers a more flexible approach. In this arrangement, the business delays the decision on buying an owner's share until a triggering event occurs and more information about the business's value and situation are available. This type of agreement is useful when future conditions are uncertain or unknown, allowing the business to make a more informed decision later on. In summary, buy sell agreements are essential for ensuring an orderly transition of an ownership. A cross purchase agreement involves each owner insuring the others, while an entity purchase agreement puts the policies in the business's name, and a wait and see agreement provides flexibility by delaying the buyout decision. Each type offers unique benefits and is chosen based on the needs and structure of the business. Let's look at the events that might trigger a buy sell agreement. A buy sell agreement is designed to automatically activate under certain conditions. These conditions include disability, divorce, retirement, withdrawal from the business. First, let's look at disability. If an owner becomes unable to work due to illness or injury, the agreement may require that the owner's share be purchased. This provision helps protect the business and secures the owner's family by ensuring a smooth transfer of the owner's interest. Next is divorce. In the event of a divorce, complications can arise regarding the division of assets between husband and wife. A buy-sell agreement offers a clear process for transferring an owner's interest, which helps maintain the business's stability. Retirement is another common trigger. When an owner retires, the agreement usually calls for the sale of their share to the remaining owners or to the business itself. This ensures an orderly transition without disrupting the business operations. Finally, if an owner decides to withdraw from the business voluntarily, the buy-sell agreement provides a pre-arranged method for selling the departing owner's share. This avoids potential conflicts and ensures that the business remains under the control of committed owners. In summary, the events disability, divorce, retirement, and withdrawal are some of the components that can trigger a buy sell agreement. By having such provisions to overcome these issues helps businesses maintain continuity and protect the interests of all other parties involved when such significant changes occur. Let's look at the entity purchase agreements. One key feature of a properly designed buy sell agreement is that it clearly specifies how the purchase price is established by setting a clear formula or a method to determine the value of the business. This properly designed agreement removes uncertainty and potential conflict during the sale process. In simple terms, a properly designed buy sell agreement does two things. It guarantees that the business owner's estate can sell the business for a fair price, and it lays out exactly how the purchase price will be calculated so all parties know what to expect. This kind of arrangement is very important because it protects the interests of the owner's family and the business itself. It makes the process of transferring ownership smooth and predictable, ensuring the business continues to thrive under the right management. So, let's end this discussion with a summary of some important tax and insurance points that go along with the buy sell agreements. A buy sell agreement offers a clear and organized plan for transferring business ownership when an owner dies, becomes disabled, or retires. This plan not only ensures that the business continues to operate smoothly, but also protects the interests of all parties involved and the business itself. Some important aspects of these agreements include several tax and insurance details. First, there is a tax on death benefits. When a life insurance policy pays out after an owner's death, those funds may be subject to taxes based on current tax laws. This factor must be considered during planning. Next, the agreement usually requires one policy per owner. Each owner is covered by a separate life insurance policy, ensuring that the funds available are adequate to cover each individual share in the business. Another important point is determining who gets the death benefit. Depending upon the agreement, the death benefit may be paid to the business or directly to the surviving owners. This ensures that a fair buyout of the departing owner's share takes place without confusion or conflicts. Lastly, it is important to note that the insurance premiums are not tax deductible. The payments made for these policies cannot be deducted from taxable income, which is a key consideration in overall financial planning. In summary, a properly structured buy sell agreement not only provides a clear path for transferring ownership but also addresses potential tax issues and sets clear rules for insurance coverage. These elements work together to protect the business, its owners, and the departing owner's estate. Thank you for watching. Please subscribe to my channel for more easy to understand business planning insights. See you in the next video.